Hello, everybody, and I want to welcome you to another episode of the Capital Gains Tax Solutions Podcast, also streamed on Expert CRE Secrets Podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to exit highly appreciated assets. Defer capital gains taxes, eliminate the need for the 1031 exchange so you can create and preserve more wealth when selling Bitcoin, real estate, primary homes, stock, anything of any value that has a large gain. You're going to want to have a good tax flow plan. You can check that out at capitalgainstaxsolutions.com. Hey, I'm excited about our next guest. He's out of the great state, originally of Illinois, the Chicago area. And he has a mission for helping all of us create and preserve more wealth through mobile home park investing. And they focus on capital preservation and risk-adjusted returns while helping to solve the affordable housing crisis in America. Please welcome to the show with me, Jonathan Tuttle. Mr. Jonathan, how are you doing, sir?
Good. It's the great state of Illinois. I've never heard that before, like in that intro. It's hilarious. But yeah, nice to be here. Thank you.
Absolutely. Michael Jordan, man, if he's from, if he's there, I mean, it's always going to be great when Michael was there, right? So
the 90s, yeah.
The 90s, baby, it was pretty great. But for our listeners getting to know you for the first time, would you give us just a little bit more about your story and your current focus?
Sure. Yeah. Just kind of like doing the digital nomad life. Been in the mobile home park space since 2006-07. Before last crash, I saw I saw how it performed after the last recession. That's what really got me full focused on it in about 2011. I've been like commercial real estate for before that. Then got into partnered up with some of the biggest brokers in the U.S. on the commercial real estate side. And then now I'm kind of just doing a combination of both like the mobile home park side and then digital. I've got some digital assets as well and a beverage and some e-com stores and things like that. So it gives me the ability to travel and while building equity. So.
Awesome. I believe we've all been given certain gifts in this life, and these gifts have been given us to be a blessing and help to others. People call them strengths, superpowers. I'm curious, what do you feel like Jonathan's like top strength or two strengths are, and how does that help how you help and bless people today?
I think energy and just being really just want to learn everything. So I've always been adamant about just continuing education and then also diving deep and to find like the real answers. So we're in a really digital world nowadays. So you actually you can buy results, you can buy data really fast. And I think a lot of people should take more advantage of that going forward, not just relying on AI. I think a lot of people are just using AI as kind of a scapegoat and they don't really understand the data. So.
Good. Excellent. I love that. So wanting to learn more, energy, diving deep to find the real data or I would say analyzing the data, right? Understand the numbers so that you can make good decisions. With that being in mind, let's talk about mobile park investing. So Jonathan, what is the number one secret to mobile home park investing?
I think it's not really a secret anymore. I think when I got into space, it was really low key. It was a lot of good old boys, and still is like the bigger park owners are still good old boys. And now you have a lot of institutional money coming to the space. But back when I first got into space, you tell people about mobile home parks and they're like, what is this? This is like right when the internet and social started to blow up and people are kind of like, what is mobile home parks and mobile home investing? And now it's pretty mainstream now. There's a lot of course creators. There's a lot of institutional money in this space. The big thing is it's just another version of affordable housing. But keep in mind, there's like a short-term run. I think there's like a 5 or 6 year run. Right now, I've actually seen a lot more opportunities comparatively to the last 2 years because of the interest rates of like normalized. And I think some of the owners have actually got out of their head like, hey, these astronomical offers are actually coming away now because we can't get funding for it. And so I think right now is a good opportunity for people in the space if they're really strategically focused and have a really ideal roadmap where they want to go with the park space, but understand the dynamics behind it. It's not the same as multifamily. It's not the same as other commercial real estate because there's a lot of unique nuances and a lot of legalities you got to worry about. And additionally, besides that, it's just a different niche. And so a lot of people automatically assume that it's just going to be like, oh, affordable housing, I have to do nothing and just buy a park and it's turnkey. It's not that. There's always work. There's always work.
Yeah, I couldn't agree with you more. And it's definitely a competitive space right now with the kind of the secret being out of the I think the less risk, but still great returns, right? But talk to me about that. I mean, what has changed in the last 24 months as it pertains to mobile home park investing, with interest rates rising and still very competitive for people who want to get into it? Talk to us just about what the state of the mobile home park investing market is right now for you, and where you're looking and where you're finding value.
Sure. Yeah. So I was just at the IMN conference in Nashville this last fall. There was a lot of big operators. I was one of the main speakers on the stage, and the sentiment there was a lot of people, even some of the operators you're familiar with, and they're probably been on this podcast as well. A lot of them really weren't putting in offers because the owners, the baby boomer owners, are like, they had these crazy offers, and he had all the brokers telling him, "Hey, your park's worth this, we'll get you this." And I'm friends with all the brokers too, but at that time, it was 2 years ago, like everything, as we all know, in commercial real estate was just that crazy boom, just printing money, and there weren't real offers to what the actual value is currently. So I think what the sentiment last year was, like, there was a lot of still, like, market was dropping, but the owner's mentality was like, "Hey, I think it's still here." And we can't get financing for here. And then now we're seeing, like, I'm getting email. People are like literally emailing me now because I rank really high in Google, actually, like top 1 or 2 for mobile home park funds, stuff like that. So people are like directly reaching out to me like, "Hey, I want to sell my park." They're not like gigantic parks, but they're usually like, $25, like 75 units. And so, like, you're seeing like a whole, like, just a total change in market where owners are reaching out. So the opportunity right now is just going to understanding that. Well, I think the biggest thing is working with owners to understand where the current market's at. And the play is, it's not like what you alluded to before. It was the whole thing before. If you looked at all the data online, all the, the blogs, it's like, hey, the highest cap rates and the best tax advantage because you have the 15-year depreciation on land improvements. And all these things are kind of like dichotomy of all of the real estate, because traditional commercial real estate is 39 years, and then 27.5 for multifamily, and then it's 15 years for land improvements for mobile home parks. And so you had all these like weird, because it's kind of like this, a lot of laws are grandfathered in, and it's just a weird ignored niche, and now it's becoming mainstream. The biggest problem is there's only like 43,000 change parks, so you have to really identify what parks you're going for. And then some of them, like, there's a percentage of them, like the big institutional guys, they want the big couple hundred units. They're not going to fly their jets out to, small town Iowa for a 50-unit park. This makes economic sense. So, and then there's also those people that you've probably had some of the guys on your podcast that actually go, I know some of these guys actually go live in the parks. It's not for me, but there's actually opportunity that they just really put the boots in the ground and do like a full turnaround. I still haven't, just because of my online ranking, and just relationships and being in the space for 15 years, I still have enough, properties coming in that it still makes sense to just kind of go and pick, cherry pick the ones that make sense. And just because I have a lot of relationships in the industry, but it's dwindling down. I think you have like a 5-year run. I've been saying that for the last year and a half, but I think the last year and a half, there was not much action. So I still think it's another 5 years. And you've also got a lot of people coming to space that listen to these podcasts, and they think they can do it themselves, and they're overpaying for properties, and they don't know how, like, the magnitude of what the work entails. And so, like, me or some of my friends, I'm friends with all the brokers and friends with a lot of the institutional operators. Look for people that have been in space like 5-10 years, because they're going to know the ins and outs. They're going to tell you here's how it is. And this industry is very good, old boys, and they'll just tell you how it is. Got it. With all those things going online now, everyone thinks it's super easy. It's still got some nuances.
Great summary. By the way, you can learn more about Jonathan Tuttle by going to midwestparkcapital.com, midwestparkcapital.com. A lot of nuggets there. Owners reaching out to you directly, right? That's definitely a shift from what the disconnect was between sellers and buyers 100%. from what happened basically, about a year ago, with debt interest rates really increasing, which made it harder and harder to get debt. Loan to values, shrinking, meaning it higher equity required to get down payments because banks are lowering their risk, and then you can couple that with your long track record in the industry. It creates opportunity, right, for those to reach out to direct, perhaps to save from the broker if that's what their approach is, or just to want to do a deal with someone they know, like, and trust from being in the industry for so long. Is that a fair summary so far, Jonathan?
Yeah,
awesome.
100%.
Next question is like billionaires, right? So like the Warren Buffetts that get into this, right? Mobile home park investing. Talk about, from somebody who wants to sustain wealth, right, in a risk-adjusted way, that, but massively, right? The institutions getting into this and have been into it for a while now, but just, moving forward, right? I feel like mobile home parks is as close to like a Bitcoin. If you look at that, it's a commodity. It's a diminishing supply, right? And they're not creating new mobile home parks, right? So talk about that dynamic and how somebody, if they're worth a lot of money, want a place to preserve the wealth and create consistent cash flow, why it's better than any other product type.
Well, there's two questions, two points to that. So yeah, Warren got in the space early 2000s. There's about 100,000 homes built a year for Clayton Homes, builds about 50 or delivers about 50,000 homes a year. He also, which is the biggest manufacturer of new homes, he also has 21st his mortgage line. So he's actually also financing the mortgage side, and then he also is the biggest home builder. Obviously, he likes to vertically integrate everything and just control the, so from supply lines to everything. The biggest issue, and like if you're talking, we met at the Family Office Club. The biggest thing is a lot of family office are like adamant about, just basically apartment buildings. They have 72% are in apartment buildings, but there's very few allocated towards mobile home parks because the biggest issue is a lot of them have certain stipulations on the raise. So, for example, like some of these big high net worth families, and so you're talking about billionaires and some high net worth people, they usually have like a certain stipulation. So like, and we mentioned Kevin is one of your friends, and I remember that from the conference. Most mobile home park funds are 10, 20 million, 25, maybe 30 max. I think 25 is the biggest raise. And so some of these these funds, the family offices and some really high net worth people, they will only invest in funds that are 50, 100 million plus minimum, and or it has these different buy boxes. And so the biggest issue has been happening for the last few years, unless they're doing it through like Apollo Group and some of the other big operators, is we don't hit the criteria. But at the same time, you don't want to, as a fund manager, to do $100 million mobile home park raise because you're just going to be buying garbage, and that's why nobody's ever done it. That's actually been in the space because you'd literally be just buying deals to buy deals, and then you'd have to like infill. It's scarce in demand resources. We have like a limited supply, which you alluded to, and so an average, for context, an average C-class apartment is 25 million. An average equivalent like mobile home park in this, tertiary market or second or third market is going to be 8 or 10 million. And so the values are like significantly reduced comparatively on a price per unit basis. And so it doesn't hit some of the buy box of these ultra high net worth people, but it creates not a lot of opportunity. I think the opportunity really is for the average accredited investor or the average person between $10 and $30 million that actually wants to go on one or two deals. I think that's the opportunity. A lot of family offices and people are familiar with $50, $100 million minimum net worth, or they have one person managing their assets. They have very strict criteria. And so they haven't really gotten the space, even though they're in the apartment building. So it creates an opportunity for, if you're an average accredited investor, you're a person making $500,000 a year, a couple $1 million a year. Mobile parks are just a good way to have a stable real estate. Historically has been one of the safest, if not the safest real estate historically. Green Sheet data, all that backs up for the last 8 years, been the top performer between that. And
Got it. That's awesome, Jonathan. That makes sense. Yeah. And so it sounds like Warren is more so building or expanding,
right,
which is different than buying existing. And what you're saying is, if for those that are trying to go big on this, they raise all the capital, raise $100 million. There's just not enough deals that actually make sense, right? That you can transact and buy without having to overpay and overspend. And so it creates an opportunity for maybe that mid-tier investor, let's say below 20 million or below 15 or below 10 million perhaps, and the accredited investor to partner up with someone like yourself, Jonathan, to do these deals. Let's talk about that now, right? Talk about an accredited investor who invests with you. On average, and past performance is not a guarantee of future results, but what's kind of been the returns that you've been able to achieve for some of your investors? And also now, how is that changing moving forward? Has anything changed on those projections or just pulled back a little bit given everything we're talking about?
Yeah, the biggest thing, right, is setting expectations. So yeah, people come into the space. And so like even talking about the capital partner side, I had one partner that was we're going after some of the bigger deals. We were competing with Apollo, some of the big operators that have like, $15, $20 billion in actually commercial real estate assets. And we'd be competing with one-off deals. It'd be like 2 or 3 off-market pricing. And I had a capital partner that had like 30 plus million in the bank himself, young guy too, actually, just really seasoned guy in the multifamily space. And I was like, we have to come at this number. This is where the market is. There's not like, you can't just buy this and scoop this up and make $10 million overnight. Like it's, the other ones are doing as a land grab. And so the returns, I think if you look at all the stuff online, you're going to see all these returns. Like, the biggest thing with fund managers, everyone's saying, oh, 15% and 70-30 IRR. Like, yes, you could do that. But I think the bigger thing is like going forward, I think the bigger opportunity is do one-off deals. And like some of the bigger operators too, in the mobile home park space, they're actually putting another asset class in there just to get better deals and get to kind of diversify a little bit. You're seeing in parking lots, you're seeing multifamily, you're seeing self-storage, you're seeing some of the other asset classes. So you can get the diversification, so you can allocate the money, still get something that's, kind of the same thing, basically paying for space, kind of like parking lot and or self-storage. You're basically renting space. So it's kind of the same thesis. But historically, it's been the 15-20%, if not higher, over historically.
Do you feel like that's going to change at all, or do you feel like it's probably going to be that? It just
depends how you buy the deals. Depends how you deals and how your debt. So, and then where you're sourcing the deals from. So, like I just alluded to, like there's like we had I'm not gonna mention the area, but it was any of the big operators. It was a college university, 500 some units, ended up going for like 26.5 million, which is huge for a mobile home park. And I was like, we need to be in this range. And the owner liked the fact that we had the cash, and then we were a small like family. They were a family-owned operator. They ended up having a substantial park, and then the other two people we found out after were the two biggest in the space. If you know the space, they were like, I'm like, if we don't buy this, we don't overpay for this, we're not going to deal. And so, the biggest thing is finding your little path and avenue to, like the 5 to 15 million is just kind of like how multifamily is at 20 to $25 million, or 30 million, where you're under the radar of the big institutional investors. If you want higher returns, go for the smaller
Makes
deals.
sense. And again, we're talking with Jonathan Tuttle. You can go find him at midwestparkcapital.com, midwestparkcapital.com. So speaking of that owner that was selling, right? I imagine you mostly want to buy from the mom and pops, right? Who've owned it for many years, who've kept the rents low, who, they've taken care of the property as best they can. And they're probably getting tired and ready to retire. And they go to sell and they have this huge capital gains tax. So I'm curious, Jonathan, what's been the biggest frustration you've seen with some of these sellers that want to sell, but they go, gosh, Jonathan, I'm going to get crushed with tax. So A, I either want a higher price, or B, why don't you go find me that 1031 property to move into? And it becomes the chicken and the egg, right? Until you find the deal. But if you find the deal's going to be gone anyways by the time you sell the property. So what has that been your feel for the 1031 exchange and capital gains tax when it comes to approaching these mobile home park and owners who are wanting to sell?
No, the angle I've seen is the treasury bill, because they've built the parks in the 60s, 70s. They just want to get completely out. The kids have been out of the space for a long time. And the other challenge to that is, remember, it goes to 43,000 change parks. So there's not enough inventory unless they're switching asset classes. And so, with 1031s, the biggest issue is identify the intermediary and, all these timelines and switching asset classes. So I've seen a lot of people with the treasury bill being so high in the last couple of years. And I know a lot of brokers have been pushing this too, when the 5+. Well, you could just have a hands-off deal. And then obviously you have your unique creative solution, which I just found out about. But the treasury bill has been kind of the angle.
Yeah. And so when you say the treasury bill you've been pushing, so like, what do you mean by that, right? Because in our strategy, right, you can defer the tax, you can get out and be done with the toilet trash and liability, and you can literally put it into treasury bills, all tax deferred, but it's going to be an extra 20, 30, 40, or 50% of the proceeds. It doesn't have to be the like kind replacement. It doesn't have to go to the self-storage or the parking lots or apartment complex or something because to me, most of these owners that are baby boomers, they want to be out of the day-to-day, right? They want to be out of the having to deal with the banks and the P&Ls and all of the stuff that's associated with owning real estate today. Talk to me about what you mean by that, and if you see how the DST could be a fit for that.
Yeah, well, I didn't know about your solution until the Family Office Club, but like the treasury bill is kind of, instead of doing a 1031, just do a treasury bill. And a lot of people set up like stuff offshore. So they're having like the South Dakota Trust into like the Caymans, not even Caymans, it's like some of the smaller British colonies are out there. They'll have like really sophisticated like trust and wills, estate planning, and then throw it into a treasury. There's like, depending on the size of the deal, if it's a $10 million deal plus, it's going to be more sophisticated. If it's a smaller deal, Some of them just don't even care. They just want to get out of the space. Like I know some of these mom and pop aren't really super sophisticated. It's not the multifamily. They've had these parks in the 60s, 70s. They built them from the ground up. They had some farmland. There's some lots on it. They have them sometimes raise their rents for 15 years. And so they're not really, some of them are not really maximizing the space because they just don't really care about the money. They have a $5 million asset that's paid off. And so you see some of that a lot, actually a decent amount on the mom and pop side.
Yeah. And thanks for sharing, Jonathan. If you want to learn more about how to defer capital gains taxes on sale of mobile home parks, cryptocurrency, businesses, real estate, even save a failed 1031 exchange, you can go to capitalgainstaxsolutions.com. You can also check out our new book called Building a Capital Gains Tax Exit Plan. In fact, number one bestseller on Amazon. And we believe it's going to give you the tools, the resources, the inspiration, and to help you create and preserve more wealth when exiting highly appreciated assets, be able to defer that capital gains tax and have more freedom and make a bigger impact. Go to capitalgainstaxsolutions.com to learn more about that. That being said, Mr. Jonathan, we're running out of time. You ready for the lightning round?
Sure.
All right. Knowing what you know now, if you go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
I mean, I've always been really motivated. So I don't know. I think I wish that we had the technology when I was 25 that we have now. I think it was more of like just wishing they had the access to the technology and all the just resources we have nowadays.
Excellent. Question number 2, what's the number one book you've recommended or given most in the past year?
The past year. What's the guy from, I can't think of the name of it. It's the one. It's the one. It's the guy from PayPal. What's his name?
Oh, I'm not sure. Is it The One Thing?
No, it's not The One Thing. It's the guy from PayPal. What's his name?
Peter something.
Peter Thiel.
Yeah.
I can't remember the name of the book. I put books on Scribe. I do I put on an audiobook and I do like a book a week.
Peter's book. Cool. I like it. Second to last question. Number one way you're using ChatGPT?
I'm not really using that much. I'm not too big into that component of AI. I'm a big tech guy, but I don't like the ChatGPT that much. I think it's one of the worst tools.
Okay. Last question. After all your success, helping all the people you've helped, what's the number one way you stay centered in your values and stay encouraged to charge forward to reach even higher heights?
Just staying focused. I don't know. Just having clear focus. I don't know how to answer that question. That'd be the best.
Good answer. Yeah, clear focus. I love it, Jonathan. Hey, for our listeners who want to get into, first of all, thank you for being on the show. Thank you for sharing your wisdom on the mobile home park space. I want to encourage you to keep diving deep to find real data, numbers, continue to learn and help people create and preserve more wealth in the mobile home park space. And for our listeners who want to get in touch with you, what's one last time, what's the best place for them to find you?
LinkedIn, because I'm in 10 different companies. So Jonathan Tuttle at LinkedIn, Jonathan Tuttle 1.
Awesome. Thank you, Jonathan, for being on the show. And thank our listeners for listening to that episode of the Capital Gains Tax Solutions podcast. We're also streaming on Expert CRE Secrets podcast as well. We're starting the new podcast, Build It to Billions, so you can give it all away. And so wherever you're consuming the content today, we appreciate you. We want to encourage you to take action today. Get with Jonathan, MidwestCapital.com, or find him on LinkedIn. And or if you're looking to build a capital gains tax exit plan, make sure you go to capitalgainstaxsolutions.com to learn more about that.